No, I think my hot take right now is I think there's an insane amount of good people and smart people in Bitcoin who a lot of people in other circles are kind of underestimating because they're used to, Bitcoiners kind of being like religious or not open-minded and kind of being lightning cultists. And the reality is like you have some really smart people who can come in and learn stuff from ETH really fast and apply it to Bitcoin. And the second we get, something live that has some expressivity, I think it's kind of a new era.
Okay, Walt Smith, the true brain behind Cyberfund. Welcome.
I don't know about that. I think we'd have some people take some grief with that, but I appreciate it.
Yeah, no, I mean you guys got a stacked team, a lot of amazing people there. So, I guess it'd be good, like maybe for people that don't know you, like give a little bit of background on yourself, how you got into the space and got to Cyberfund, and then we'll actually touch a bit on, cyber and your guys' investment thesis and all of that.
Yeah, happy to do it. I think I have a pretty, typical story. I kind of got turned on to the space by the really hard Bitcoin stuff. Sound money. I think Sadov, I forget how to pronounce his name, but the guy who wrote the Bitcoin Standard, I read that in like
Oh,
2017,
safe.
2018. And, very much the idea that we lived in like a fiat kind of cheap world. I think if you look at like, older societies, they did build in, bricks instead of wood or even worse stuff. But yeah, I was always wanted to be a doctor, kind of going that route in college, and worked at a few startups, kind of saw the bureaucracy of medicine, ahead of time by reading some books and talking to some doctors, and then just, fell in love with Bitcoin. My brother kind of told me about it. I had a bunch of professors who were hardcore gold, kind of Austrian econ, kind of that descent, which I think, a lot of the early cypherpunk movement, while it was tied to privacy and free code and open source, also very much grounded in this idea of separating state and money. This even goes back to, the beginnings of PayPal, which was trying to start its own currency. And, you had things like DigiCash in the 90s. So yeah, I think I just fell in love with the idea and was very convinced of it. And I thought, if there's one thing I could really put my career towards early on, it would be this. And just kind of through circumstance, ended up working on a research team. Eventually that led me onto a trading team doing prop kind of directional trading, mostly of crypto stuff. And that's when you get into the nitty gritties of, different network designs and how the different network designs kind of affect the economics. And obviously, the economics for networks are really important because it affects like the long-term stability, which I think, has been topical in Bitcoin, at least since the early days, and is topical in Ethereum right now. And that slowly transitioned into venture. When I realized that's how you got to work with the smartest people, you got to work with founders and really great teams that come around really great founders, which I've seen, a huge thing there with Alpen for sure. And after doing trading, worked on venture for a while, and then finally met Constantine, who's one of the oldest, kind of crypto people in the world, has coined a lot of the, the famous terms such as digital assets back in like 2012. And it, did a lot of interesting stuff with Bitcoin way back in the day. His first fund, Cyberfund, some Cyberfund lore here. I'm happy to talk more about my career if you have a specific question, but some Cyberfund lore is originally was called Satoshi Fund. And this is back in like 2013, 2014, before the Ethereum ICO, and kind of rebranded to Cyberfund. But yeah, that's kind of the general gist is just got very pilled on the libertarian elements of Bitcoin and kind of technology beating out politics over the long term. And I think Bitcoin by far is, the fastest and the best horse. And that's kind of all led me to where I am now.
So you mentioned a couple things that I want to poke on. So you said your brother Will, like, got you a bit into the space, and so Will is like he also runs Block Space Pod with Guard and those guys, right?
Yeah.
And so
Go ahead. Sorry.
no. Well, I'm just curious more about that. Like was it initially coming into Bitcoin because you guys went like a little bit of different paths, and now it's almost like converging a bit where there's like this kind of interest back in this like Bitcoin L2 space. Like, did you guys have divergent views on the industry, or have you always been, pretty well aligned?
Yeah, I think that's a good question. I think my brother was one of the earlier people covering DeFi, kind of in the reporting space, and he would tell me about it, and that was kind of when I was newer. So I think it was still more on like the Bitcoin maximalist stuff, which I think the Bitcoin maximalist stuff is wrong, but um, I think the idea that like it's winner take all and that Bitcoin's the winner is not wrong. I think kind of the lens they come through with or how they want to play the game on the field is wrong. I think they want to play just call people scammers and win that way. And I think the real way to win is to out innovate and out compete in kind of this free market, which I think Bitcoin is doing now. He kind of went into the Bitcoin energy mining space, I think, because he had a lot of connections in it and was really fascinated by energy markets. And they're not just adjacent to Bitcoin; they kind of are Bitcoin. And I think he got like a depth of understanding there. I had some path dependency where I very much ideologically was still a Bitcoiner, but because I was working in a trading desk, you kind of have to think about things openly. You kind of have to examine your assumptions all the time, and that takes like a lot of work. So you have to go, read about Polkadot, read the Polkadot white paper, or know about, Polkadot parachain auction slots and how that will affect, the trading of DOT, which is not necessarily, the knowledge you want to flex on people, but it is, part of the job. I think, what kind of came back to me was, that kind of midway through 2023, when I was really getting into venture, I just kind of got lucky that I think that's when a lot of the good Bitcoin companies were, had been around for a year or were really starting to form, who I think are going to lead this next wave. So, I think, it was a confluence in one way, but I think a lot of the learnings, obviously, from Ethereum and these other ecosystems are becoming relevant to Bitcoin right now, which is exciting. And I think, there's some relevant knowledge there, but I don't think I ever lost the ideological outlook.
Yeah, yeah, I love that. I think it's all coming back together. The other thing that you had mentioned, did you say that like some of your professors or universities when you were kind of like first exposed to some of these Austrian ideas?
Yeah, there's a really cool story here. So Ludwig von Mises and Friedrich Hayek, I think, are probably the two most well-known Austrian economists of the 1900s. Mises was in Vienna, and then the Nazis kind of came in and squashed libertarianism, and the libertarians had been fighting the communists, and there's some famous papers in there like economic calculation under the socialist commonwealth, I think, is like Mises most famous paper at that point, and then he writes a couple books. Hayek goes to London. Mises goes to NYU as a visiting professor. And his first student was actually a German prisoner of war, Hans Sennholz, who wrote, this kind of famous in, libertarian circles pamphlet called Fetters of Gold. So he was actually a fascist. I don't think he was a Nazi in the truest, worst sense, but definitely a fascist. And he eventually, wound up in Grove City, Pennsylvania at a small college, was friends with like Milton Friedman. I'm blanking on the name of the other guy. Murray Rothbard, like some of these, name people, but was kind of quieter and ended up there, was, Mises' first PhD student in the US. And when Mises died, he sent all of his personal effects to Sennholz, who's at, Grove City College. And ever since then, it's had like a really strong Austrian tradition. So a lot of my professors, were visiting professors or, chairman at the Mises Institute in Auburn, at Auburn University and stuff. The technology element wasn't necessarily always there for them, but I think they've strongly related to a lot of the ideas that Bitcoin has pushed through, such as sound money, separating, state and money, kind of taking the teeth out of the government's ability to inflate everyone's wealth away. But yeah, I mean, the lineage, it's really great. You can trace it all the way back to like Karl Menger and in the marginal revolution at the turn of the 19th century, all the way back to Frederick Bastiat in France. And then all the way back, there's some school called the School of Salamanca. I don't know much about it, but it's Spanish monks who were like, how do we stop seigniorage of gold in Spain in the 1400s? So it's very cool. It's a very cool tradition. And I think it's, right at the heart of Bitcoin.
Yes, I love that. I love hearing these stories of how like people were kind of like introduced to these ideas like during those university or college or academic years, because so much of the narrative is that we all took these like really crappy economic courses and they taught us like how inflation is good. And I think there's like legitimacy to that. Like, I think that is probably the majority. But for me personally as well, like I took a, philosophy of economics course when I was at like University of Arizona because we were told it was like an easy A. And then all of a sudden we're in there, we're reading in like, we're reading The Fountainhead by Ayn Rand. And I remember like, yeah, I was in the fraternity, and like I remember even some of the fraternity guys are like, hey, like this Ayn Rand lady, like she's kind of base. Like these are like
Sure.
cool ideas. And then and then that led me into the introduction of like Austrian economics and just kind of like the morality around capitalism and non-sovereign money. And so when I did eventually find Bitcoin, which was much later, like I was predisposed to these ideas, which I had discovered during these like kind of like, I would say, impressionable years where you're kind of like in college, your mind is a little bit more of a sponge, and and so yeah, I think that's really cool. And I didn't know all that history about Mises and kind of like how it found its way over to the U.S.
That's super interesting. There's a lot of, it's some sharp elbows because it's academia, so there's not a lot of money to go around, but it's still super interesting.
Yeah, very scarce money. Um,
The most scarce money. That's funny.
okay. So let's bring this back on course. So you touched a little bit on cyber, but like tell us more about Cyberfund. What have they done in Ethereum, and what's kind of like the investment theses that you guys are pursuing?
Yeah, I think the thesis has always been the same for cyber. The entity cyber has kind of taken different shapes. Like I said, it kind of started as this thing called Satoshi Fund. It was very active kind of in the Bitcoin space early on. I think it was like basically a DAO on Bitcoin that just held Bitcoin through a multi-sig for some limited partners. That kind of evolved with the Ethereum ICO and I think experimenting around with different networks and different currencies and very much this was like the app era of blockchains where people were like, we'll put Uber on a blockchain and it'll be decentralized and that'll make it great. Not that people really knew what that meant, but I think Constantine more than anyone was involved back then. He's had a really interesting career where he kind of has kept the entity, was one of the original people around it. It looked similar to like a Masari or one of these data providers, but had kind of a fund attached to it. That evolved as his partners kind of left and it kind of shuttered to outside capital, but he kept the entity alive and just kind of invested out of it and kind of worked with great entrepreneurs out of it. So his career has spanned from like Bitcoin mining all the way to like doing Solana's first round, being close with Anatoly, who I've actually never met despite working at the fund. I think the most interesting part of it has been kind of the thesis and the backdrop for this and kind of this idea of democratizing access to technology and kind of globalizing while we're verticalizing at the same time. So whether that's being an investor and being able to invest as well as someone in Silicon Valley, even though you're in Europe or some other country far away that historically doesn't really have access to, also just building networks where anyone can kind of access the financial infrastructure, can access the money, can access the revenue, can access the yield. And I think that's just the start. I think private compute is coming. I think a lot of these cybernetics ideas are coming. So kind of back to the heart of it, initially it was an investment company, kind of worked closely with the early proof of stake network, which was Cosmos. I think was the first one to really go live that was mainstream. Cosmos kind of had this interesting issue where in delegated proof of stake, if you just had the most stake, you would just get the most slots, which would lead to you getting more stake. So despite the goal of being decentralized, it tended to be pretty centralized under the hood. And when Ethereum was kind of switching over to proof of stake, I think that kind of was the impetus to kind of democratize that. So Constantine, not only invested, but he helped found P2P and eventually was a core contributor to the Lido DAO and kind of was there on day one, which is now the biggest liquid staking provider and has kind of pushed the cutting edge on a lot of staking stuff, which has become increasingly relevant for Bitcoin in the last year, and I think it's kind of always been in the back of people's minds since kind of the Vitalik critiques of proof of work 2014 days. In terms of the thesis for Cyberfund, I think it's always been the same, that we're trying to push forward human flourishing, and there's kind of this world where technology is top down, where it's kind of technocratic, where it's managed by a few, where it's kind of colludes with the government for kind of local optimums where people extract a lot of rent, whether that's closed source AI, whether that's traditional financial rails, whether that's only 20 I think banks have bank accounts with the Fed and are kind of member banks, whether that's all the lobbying money that Coca-Cola spends with the National Diabetes Association. There's a lot of ways to kind of look at this like unipolar very heavy top world. I think technology is, it inherently it's a power law, but you can kind of have open access and you can kind of let anyone participate and kind of let anyone vote with their dollars, vote with their feet, and enable them to have that sovereignty, and kind of having humans in the loop and getting these efficiencies and pushing us towards this like singularity where all technology, not just computing, is growing really fast is the goal. And I think anything that aligns with that vision and is more about human flourishing than it is about capturing or kind of stalling the economy in any sense is definitely, in the bounds of Cyberfund's thesis.
Okay, yeah, very interesting. So huge depth of experience there. Cyberfund was kind of like major players in bringing, Lido and liquid staking tokens to the forefront of Ethereum, and like arguably like there is like very heavy kind of like Ethereum leanings there. So I guess my question is like you guys decided to come in and co-lead our most recent round in Alpen. And my question is why? Like we're building Bitcoin ZK rollups. Obviously, I'm very biased here, but like why would Cyber want to kind of like step out of the Ethereum ecosystem, something that they are pushing forward the frontier, and kind of explore this new niche?
Yeah, I mean, I love that. I love that question. I think there's a bunch of things to love about Alpen as an investment. I think, when in 2022, John Light, who has now joined Alpen, wrote a paper, ZK Rollups on Bitcoin, and it was kind of this idea of if we wanted the expressivity, if we wanted the execution, and the programmability of an Ethereum, of a Solana, of any other network that's out there, but we wanted it tethered to Bitcoin so that Bitcoiners could use Bitcoin as gas. They could self-sovereignly access this and self-sovereignly exit if they wanted. That's what was kind of the idea for what ZK Rollups would be, kind of unbundling the scaling and the expressivity of Bitcoin, the currency, away from Bitcoin, the network. I think that's the like highest level. I can get into the specifics of the team, which I'm happy to talk about, as well as kind of the technology. I think more than anything, Bitcoin has kind of this store of value premium. It has kind of this moneyness premium, but the utility is still kind of bottlenecked by the consensus network. And if we could get the utility in payments to be up to speed, to be comparable to a Zelle, or even crazy idea as fast as a Visa, like people would use Bitcoin in payments. And if people started using it in payments, it would look closer like a money alternative, or a gold alternative, or even a US dollar alternative. So I think more than anything, that was the ideological push for us. And then, having this kind of thesis around expressivity, around Lightning not working, around, the native apps kind of being necessary to incentivize usage and kind of induce demand for the network. Then it was about the team ultimately. And I think that's, when we met Sims and met Hugo, the rest of the team, that's where we really fell in love.
Yeah, so let's actually do this. Like maybe I could prompt you to maybe give Steelmans against whether it's Alpen or Bitcoin or ZK Rollups, because a lot of these podcasts that we're doing, admittedly, it's just the people that I'm influenced by the most are our core team. Like I'm very biased to this idea, and I think people will have a lot of content on the promise of these. But maybe, and if you want, I'm happy to give some context as like, oh, sorry, your camera went off for a second. Okay, you're good. But maybe we can give some examples of like, where do we think that these things could or will fall short? Like what are the limitations of like how far we can actually push this whole new renaissance in ZK rollups? Help me give some Steelmans against it.
Yeah, I think the first one is just distribution. I think the scary thing for Bitcoin is just the dollar's ingrained. It's got a bunch of aircraft carriers all over the world, and it's got agreements with OPEC and many other structural advantages in terms of the distribution. And distribution is really, really sticky, and now you kind of have to outsell those people. The flip side is just Bitcoin doesn't inflate, obviously, but I think that distribution is going to be really, really, really tough. And culturally, not everyone speculates to the same degree as people in the United States are used to. In India, there's not as much as a culture of speculation. In South Korea, there's arguably more of a culture of speculation. So it kind of depends on where you are in the world. But I think just that inherent volatility and kind of the distribution of the dollar, and as dollar rails have gotten really good with stablecoins, stablecoins are going to be on Alpen. That's arguably competing with people spending, saving, holding their reserve balance in Bitcoin. I think the other Steelman is kind of the technology layer stuff. There's just kind of limiting stuff you can do in Bitcoin script. There's limiting stuff in 4 MB blocks. How much data you actually have to post to the chain. How secure are alternative data solutions long term? I think these are very kind of open questions that are kind of scary, and we'll see how it kind of plays out, because it's going to play out. It's not something that'll be theoretical for much longer, which is a good thing. I think we'll learn more from experimenting and tinkering, and I think Bitcoin has proven, the China ban, the inflation bug, I think that was in 2016, have kind of proven that the network can kind of survive these things. In terms of other Steelmans, I guess, there's going to be kind of these practical limits around how many transactions you can get in an EVM, or, another rollup instance, or how do you kind of tie these things together in a way that the user experience is really great? How do you like standardize the interoperability behind them? I think that's something everyone's kind of grappling with and continues to grapple with. And then lastly, there's just circuit bugs, especially in ZK. There's just like, it's pretty hard engineering, and I think there's always the risk of like a 0 day, whether for the bridge or for something else. Like, there's extreme security risks. Does that mean we shouldn't like go forward? No, I think these are all things that humanity has always grappled with. And I think there are things that we'll overcome. The last one I'll give you, which, I'm happy to riff on, is the security budget, which I think a lot of people, have theorized about this. A lot of people have modeled this. I know some people who wrote on Bitcoin stability back in 2016 are again visiting the topic now in the face of, high fee variance, which used to not exist. But I think the security budget, kind of remains a critical question for Bitcoin, whether it's federated long term, and, you have companies like Alpen who are also running Bitcoin miners and kind of internalizing the DA cost to themselves that way, or, Cash App is running miners, and their business just kind of has an operating cost of running a Bitcoin mining node, and they don't cheat the network because they have a rational kind of business attached, not like a Byzantine kind of security model. I think that's a different Bitcoin. As long as the 21 million, I think, that's the highest, sacrament in Bitcoin is just the 21 million. I think there's a lot of, holes to poke, but, with any good startup, there should be, a lot of hard problems. Otherwise, smart people want to work on them.
Yeah. Okay. So many things that you touched on that I just want to recap. Like, I think it was really important, and it is important for us to like not turn this into like an Alpen or ZK Rollup, like Bitcoin shillfest. And I think a lot of the points you brought up are valid. That like we do have constrained block space on L1, but we could do off-chain DA, but you inherit some additional trust assumptions. Like, we don't technically have like single slot finality, but you could emulate it with maybe like economically secured pre-confirmations. Like, you don't have this perfectly trustless peg, but you have one of N, which is like pretty good. These are the things that I think it's important for us to highlight and be like hyper transparent about. Like, this movement's looking pretty damn good, but like, these are potentially limiting factors. The other thing that we can now like move on to is this whole security budget, MEV. You wrote this like, pretty good sized article that kind of like delved into this whole world of MEV. I want to talk about all of it, but admittedly, the thing that I'm most interested in is like, if you think there's implications for MEV with the introduction of CAT. And I'll tee up the context here that if we get OpCat, some sort of soft fork in Bitcoin, it can allow us to do some form of covenants on Bitcoin, but it could also enable what's called like a native ZK verifier on the layer 1, which means we would eliminate the whole BitVM game, and we can just have this like trustless settling of the roll up to the Bitcoin and create this two-way peg. Now, I think that there is pretty strong evidence that MEV could and will exist on the layer 2, but it likely will not bleed down into the layer 1 because it would all be captured on the L2, which kind of insulates us from MEV bleeding down to the miners, which could cause centralization. Some people would contend that moving aside the ZK rollups in the layer 2s, that once CAT is enabled on the layer 1, you could hack together these kind of like, whether it's AMMs or different functionality, and they'd be ugly and super bad, but that it could lead to applications which give you this unbounded amounts of MEV, which allows certain miners to extract more value, which centralizes them. Did I do a fair job of explaining that? And do you think there's any credibility to that claim, specifically on CAT? Then we can go to the broader ecosystem.
I'm going to preface this first off and say, I have not worked at Flashbots or any of the other really good MEV focused companies. I think, I'm very interested in the subject, and I've read a lot of the good writers. And, I think I have my own opinions on this that are, kind of comparing by analogy. But I think that's okay. So I'm happy to opine on it and kind of give you, a years later look at it when we really dove into this question about a year ago as a team and talked about it a lot. I think the reorg risk on Bitcoin is substantial, and I think the reorg risk on Ethereum is substantial, but we haven't really observed too much reorg stuff. And I think that's because everyone kind of knows who the node operators are, and it's the chain's modeled as Byzantine, but sometimes people act more rationally. Lido acts more rationally. Whether specific MEV searchers, like what tit for tat economics they kind of have in the network, I think determines, if they're rational or Byzantine, meaning are they acting, kind of short-termism and harmful to the network, or do they have a longer-term incentive to actually, work with the network?
Let's
I
pause
think
there for a second. I
yeah,
just
go
want to
ahead.
make sure we go forward. Explain this idea of reorg risk, and maybe you're implying fee sniping. So how does that happen? Why does it happen? And what's the concern there?
I think it's like fee sniping or transaction sniping. Like if, a transaction's sent into the network and it's in the mempool and people are kind of hashing on the nonces to discover a valid nonce and make a valid block. And let's say it's like a really high fee, like the Babylon network going live kind of launched, or, the rare set that happened in April 2023. That can incentivize, another miner to come in and say, oh, that would be a month's worth, 6 months worth of our revenue. Let's go mine that block and not build on the same block. And then the network splits. And, a short-term split historically has been called a feather fork. And those kind of happen all the time and they resolve. But I think the risk and the fear is if miners couldn't reliably earn revenue, then they would start working with the biggest miner or the most sophisticated miner who's doing the fee sniping. And then the chain would centralize. So the reorg risk would kind of incentivize, whether it's selfish mining where you mine a valid block, but you don't propagate it to the network, and then you mine the next valid block on top of it and then release two at once so you can kind of outcompete everyone. Or it's some other form of attack around the reorg where everyone starts kind of grouping together. I think, that's probably the biggest risk for Bitcoin that I think, Ethereum and these other networks are kind of tackling with finality. Whether it's existentially, relevant for Bitcoin, I don't really have a strong opinion there. My instinct is kind of no. I think right now we have really high centralization in Bitcoin mining, and I think that'll go down with fees. Because I think if you originate, if you're Marathon and you kind of have this side chain L2, you want to harvest the fees for the DA being posted to the L1. So you're not going to send it to the mempool. You're going to send it to Marapool. You're going to send it to Slipstream, and you're going to harvest kind of your own proprietary UTXO flow. And then I think that's when it gets really interesting. That's when you can talk about AMMs on Bitcoin, what that would look like if people would even use them. I kind of doubt they would, because I think the slippage would just be too great and the reorg risk would be too great where you'd get zeroed on trades. And there's, much better alternatives that are sufficiently decentralized for traders, where I don't think an AMM on Bitcoin is really relevant with CAT. I do think in terms of, an Enduro or a Marathon kind of harvesting this private UTXO flow, it kind of looks like, business is verticalizing, and then the chain's kind of more federated because you have these, very sophisticated actors who have businesses built on top who are relying on Bitcoin, whether it's Cash App or, some sort of decentralized exchange built on top of Bitcoin. But they also need to, kind of internalize their cost, and their cost is, posting DA to Bitcoin or getting, all the DA onto their L2. And I think you end up in kind of a federated world there. But I think, again, you go back and you say, this is where it's interesting. Let's look at Ethereum. Let's look at the two really bad things there. And it's private order flow. Well, private order flow in this case is very different because it's not on the L1. It's only on the L2, ostensibly, because people aren't going to trade on the AMM, which is a strong take, but it's kind of my view at the moment. And then it's private order flow, and I'm totally blanking on the other one. Sex to Dex ARB again. And if there's no AMM, you're not going to have Sex to Dex ARB, which is high frequency trading. Whoever's the fastest, the most sophisticated on Binance ends up winning that. And it's very, very centralizing. I don't think either of those are going to exist on Bitcoin. So then I think, the fee variance is kind of BD driven. It's kind of sales driven. It's, can you launch a really good ordinals collection? Do you know how to internalize the ordinal stuff? Can you build a semi-valid block fast? And I think right now, we have a ton of hash rate with Antpool. and Bitmain. And I think longer term, you should expect that to go down. So while I think the floor for Bitcoin mining will always be very high, you always need at least, 3 to 6% of the hash rate to be a profitable miner running your own pool, kind of like Marathon is right now. I think the ceiling for how centralized you can get will go down because to harvest your own ordinals collection is kind of a BD sales effort. To kind of mint it and have it be popular is kind of a BD sales effort, which is lower stakes than sex stakes are, but it's less kind of competitive in the sense that it's not winner take all. And anyone can kind of do it. And you want to internalize your own. And you don't trust, if you have very high fee variance, you're not going to trust Ampool to pay you. You're not going to trust, if you're a Marathon and you're doing an ordinals mint, you're not going to trust like Ampool to give you the full pay, the full shares that are due based off of your hash rate percentage. You're going to mine it yourself because they can always kind of skimp you off the top. They can always kind of take some, and you're going to want to mine with your own equipment. I also think there's like some national sovereignty questions here with energy markets, but I talked a lot. So if you want to follow up on something there, sorry.
Yeah, so there's a lot here. So let's try to break this down because I think I was able to follow most of it, but not all of it. So I think we'll lose a few people. So you had mentioned that you do think that there is this risk of reorgs moving forward in Bitcoin. And again, the idea of a reorg is like some sort of block gets posted. Somebody says, hey, whoa, holy crap. Like there was a lot of fees that a miner earned in there. So the next miner that mines the block says, actually, like I'm going to remove that block and I'm going to give myself the block so that I'm now earning the fee. And this is this fee sniping issue where people kind of go back and forth to battle for those fees. And my question, though, is like you say that there is risk of reorgs in this issue happening, but we've seen significant, as you alluded to, times where this kind of fee in a Bitcoin block spike, whether it was from an ordinals mint or whether it was from like, Babylon was the most recent example, yet there weren't actual reorgs. And so why do you think that is? My intuition is that the game theory is like miners don't really want to play in that game because it's eventually ticky-tacky back and forth where it's like, well, you reorged us, I'm going to reorg you. And it kind of undermines the entire credibility of the network. And people are like, that just, it's a negative sum game for all of us. So what are your thoughts on that?
I think, I'll give you my kind of more technical ones, and then I'll give you like my like higher one. But I think first off, there's a huge opportunity cost, which is hashing on the next block and then hashing on the block after that, which still has a Coinbase reward, right? And 3.125 Bitcoin is a ton of money to make over 10 minutes. And that's kind of your cost of playing in these reorg games. If you don't have that cost, I think, an amp pool, reorging like an amp pool, or not an amp pool, like a slipstream block or reorging like the rare sat or a Babylon, block is probably worth a lot more because it's the only revenue you're going to get for a while. The fee variance is going to be pretty high. 1 out of 100 blocks could represent 90% of the revenue. So you could, see a lot more of this forking. Right now, a lot of people are just mining with Amp Pool or other proxy pools. So they don't really have access to the block template. So they don't get to choose if they want to reorg. They just kind of get their payout based off of a share of the hash rate they're providing to the pool. And that's based around the Coinbase issuance, not even the fees. So people aren't even, set up to win and kind of make money in this ball game yet. I think that's part of the reason. That said, we still saw it. We still saw it with, the rare sat mint in around the halving, like one miner did try and reorg the block. There's also, reorgs periodically that just kind of happen. So I think, the microstructure of Coinbase issuance and where the fees are at now, the fees are not high enough and the Coinbase issuance is high enough where there's too much of an opportunity cost. I also think there's a lot of vendor lock-in on where people are mining and how they're mining. And then ultimately, I think, there's kind of this like MEV acceleration question. How sophisticated do you want your miners to be? Do you want them to be dumb? Do you want to like provide software so that everyone can be smart? Or do you want everyone to remain dumb and kind of not profit? And right now, I don't think there's a huge degree of sophistication in the mining. I don't think people are really, nobody's played with like a Bitcoin client itself. People are playing with kind of the mining software a lot, like Stratum a lot. And, we've seen kind of Andorra, we've seen Ocean mining, implement like a different fee model, which is supposed to be more open and kind of more equitable so that you make the fees, not just the Coinbase issuance. But I think more than anything, it's miner sophistication and kind of the economics aren't worth it right now.
Okay, so I think your theory is there that the reason that we haven't seen some of this reorg risk is that when you get into that battle, you're losing, like you said, the Coinbase, like the actual 3.25 or whatever Bitcoin. But maybe as we go through more halvings, you're saying that becomes less of a deterrent. So your theory is that maybe reorg risk increases as we get through more halvings. Am I right there?
Yeah, and then you'll see more sophisticated strategies, whether that's selfish mining, withholding the block to build two valid blocks to kind of outstrip the chain, or something else. I think miners, as the revenue goes down, they're going to have to look to alternative sources, whether that's taking some off your buddy's block, or launching your own L2 and trying to verticalize. There's a couple strategies that I think will become popular, but right now it's too much money to kind of forego and have to think about. I think, the cost of energy can spike. Coinbase issuance will certainly go down in the next 8 years. And then I think, the mining strategies will change a lot.
Okay. And then the next one, I want to talk about this like idea of private order flow. Right now, if we just assume that there's like this public mempool where it's like you mine a block, you can go look at the public mempool, you can pull down the transactions that have like fees associated with them. And that feels like more of a fair game. I think what you're implying with the private order flow is that maybe some sort of big miner, I'm just going to throw Marathon out there or something, can go up to people that are doing big, ordinals mints that are things where it's like you're going to submit a ton of transactions, you're going to pay a lot of fees. And instead of that going into the public mempool, that Marathon can say, no, just do this like through us, what's called like out of band. Am I getting this right? And that will be considered private order flow because it doesn't go through the public mempool. And because of that, these entities like Marathon have a distinct advantage over other people because they alone are seeing the fee revenue associated with those transactions. Therefore, they're able to be more profitable, which means they're going to grow to a larger percentage of the hash rate. Am I getting that risk right with the private order flow? And if Marathon does mine a block that has a bunch of private order flow in it, can that be fee sniped? Or since they own the private order flow, like nobody else can access that after the block has been published?
Right.
I think once it's published, you can actually reorg it, but I need to double check my block semantics. I'm pretty sure that's right though. I think on your first question in terms of the private order flow, I want to preface this again on an expert. I think there could be some interesting, I think in Ethereum we've seen two cut instances of really centralizing MEV. And that has been private order flow and sex-to-sex arbitrage. And, you can kind of say sex-to-sex arbitrage is like, this private order flow that someone's more sophisticated than you on Binance and faster. But, private order flow in this case is kind of saying we have these unique customers, they're kind of surfacing unique transaction flow, and we're the only ones who are going to build these blocks. I think that is really centralizing in kind of the builder world. In terms of staking, it's very different, obviously, in Bitcoin because it's proof of work based. So I think you have to look at like what's the energy variance for the miner, how likely is that miner to stick around. We had a ton of bankruptcies in 2022. There's kind of more of a natural churn there. I do think, let's say if you had Base and it was built on top of Bitcoin and it was like surfacing all this revenue, Coinbase would be able to subsidize that with miners. And then the miners, would be able to, because they have a higher percentage of hash rate, because they have this extra service they can subsidize the hash rate with, then they have a higher degree of reliability of actually landing a block. So then if you have a really important block, maybe you send it through. So there's a little bit of a virtuous cycle there. But because anyone can join the network and kind of mine on a block, and because there's, energy is the input here, not stake, there's more kind of inherent geographic decentralization. Because there's cheap energy in Alaska, there's cheap energy in Russia, there's cheap energy in South Africa. You'd expect, energy markets are very nationalized. You'd expect that to, kind of maintain course, and energy will kind of be everywhere. And sovereign countries might have an interest in, their energy markets, which means they're going to have an interest in their Bitcoin mining operations eventually. So I think you'll kind of get this like sharding, for lack of a better term, of the network inherently that you kind of lack in proof of stake. And if you already have that, then you kind of have this accountability where one guy doesn't control all of it, and he doesn't want to control all of it. Otherwise, it's kind of antagonistic to his long-term business operation. So I think it's centralizing to a point, but I think because it's not tied to the stake, it'll be less damaging. That would be like my, hot take for private order flow. I think it's less damaging. And I think it's all in the L2. I think there's going to be a lot less of it on the L1 that matters. Just because there's not going to be an AMM on Bitcoin L1 that people popularly use, because the user experience is so crappy, and there's going to be alternatives on an L2 that are just as good.
Yeah. Okay. So I think I see it as like these two categories. So there's the kind of like the private order flow, which can be a whole bucket of different things like ordinals mints or L2s posting like the state differentials and the zero knowledge proofs. And then this kind of like what we're calling the sexdex arbitrage. Really, that's just like the ordering of the transactions. And our intuition, it sounds like we're both aligned that we don't think sexdex is in AMMs on L1 is really going to function, because it's like even if you could build that functionality, it's just like you have 10-minute block times, you have mass slippage, you have like huge throughput. It's just like it's going to be so clunky that even if you could do it, that the amount of revenue you could actually extract is like, frankly, like probably de minimis. You know, I think people are doing the research on this, but we'll see. So maybe we can assume that like the AMM and the sexdex thing is like really not as big of an issue. I think that if this MEV is a big risk, it's going to be that the people that are paying the largest fees to post data onto the L1 really could let this thing spiral or make a non-issue. And I think that's going to be a lot of like the roll-up teams. Like we are going to be posting like pretty significant amounts of data to the Bitcoin L1, and like with the zero knowledge proofs. And if there was like going through this kind of private order flow, saying it's like this is only going to happen with like Marathon, and like we're going to do every single thing out of band, and like we're going to consume 90% of the block space and only work with Marathon, then I think that becomes like pretty precarious. I don't actually see that happening, but like that, if I was to steal man, like where I think the biggest risk is, it's like who are the biggest spenders on the L1, and it's going to be these L2s that want to settle to the L1.
Yeah, I think when you have a business next to another business, you can have two business models, and kind of, if one business model does well when rates are high, and one business model does well when rates are low, right? You can kind of hedge one business with the other and kind of outcompete everyone that way. That's kind of one model. I think the biggest risk is kind of around ASICs and kind of discounted ASICs or discounted pooling fees. And I think we've seen that. And I think that's why there's a high degree of centralization now. Where that goes in the future, I think, we have the CHIPS Act. We have people trying to build them in the US. We have people, like BitDeer, who have historically thought about working on stuff kind of adjacent to ASICs. So I think there's, a bunch of like ways to look at this. I think in Ethereum, you have this like staking that is kind of inextricably linked to the yield, that is kind of inextricably linked to your level of sophistication or your private order flow. In Bitcoin, you don't have that, because you have energy as the input, which provides like a higher baseline of volatility. It's more decentralized, and you don't want to like control the whole network, obviously, because that'd actually be long-term bad for your business. You'll still have the private order flow. But I think the bigger risk is actually coming up from, needing the ASICs and being able to provide discounts. And that's when you have to look at like the pooling fees and how do pooling fees get paid out when there's no Coinbase issuance and there's high fee variance? And does, being the ASIC manufacturer allow you to have a bigger pool at that point? And I think it still will be like an economic lever that ASIC manufacturers can play, but I think it'll be less relevant, because once you introduce fee variance, you need to kind of validate what that fee variance was to get your proportional share. Yeah. You can't just say, oh, it's 3.125 per block, and I had 1/10 of the blocks, so I get 1/10 of the rewards for that.
Yeah. Okay. Very interesting. So I think you added an extra element there, kind of saying that like, hey, a centralization risk that's probably more pressing is on the hardware level, on the ASIC level. Okay. I think that we've discussed this topic pretty well. Is there anything else that like you think is relevant that you want to add here on the MEV, or should we move on to Bitcoin LSTs?
One more preface that if you didn't agree with us, we didn't say we're right.
Of course. Yeah, this is us just kind of like pontificating, sharing our hot takes. But I think that was good. I think this is a topic that not many people are like super well versed in, and it is very important. But okay, so let's move on to the state of Bitcoin LSTs. So for context, yes, like I was discussing yesterday with Cyber, Cyber is kind of the team behind Lido. Lido is like the biggest liquid staking token on Ethereum. And now there's this kind of like big trend to bring yield or LSTs to Bitcoin. And the big kind of gorilla in the room right now is Babylon. And there are a bunch of teams that are trying to create LSTs. Do you think that LSTs have a place on Bitcoin? And what is your assessment of the kind of current state of LSTs on Bitcoin?
I think, Bitcoin is such an exciting asset, and the ideas behind it are so big that it's easy to get out over our skis. And I think, back to the Austrian econ stuff, anytime you have zero interest rates, right, there's kind of this desire for hyper growth. And I think what we're seeing in Bitcoin right now is kind of the inverse, where there is no interest rate, and now there's an insatiable desire for yield. And you saw a similar thing in Ethereum, I think, in 2023 with kind of the restaking stuff that came out. I think in Bitcoin, it's Nakamoto consensus, whatever you want to call Bitcoin consensus, is a lot simpler. So feasibly, you could encode more of the logic that you would want for consensus in kind of these staking gadgets, whether it's a Vault that's doing the restaking, or it's an LRT or LST provider that's kind of managing the restaking risk on your behalf and just giving you the derivative and kind of simplifying the risk reward ratio there. I think you'll see, this increasingly matter in Bitcoin. I think how it'll interface with Bitcoin mining is really interesting long term, if there's anything there. But I don't think, right now it's clear where the yield's coming from. I think you have to internalize, execution fees, or you need some sort of lending rate. And, lending on Bitcoin is going to be really expensive. People like holding it. They don't like having it at risk. So I think the rates will always be really, really high, and the Fed will always be able to kind of, tinker with the US dollar rate. So I think where the yield comes from and kind of what those, AVS is, or whatever Babylon's calling them, or whatever restaking provider is calling them, is kind of the interesting question. I think there will be a lot with Bitcoin. I think potentially more than there are on ETH. And I think it's kind of more well-defined asset to start with. Not that, ETH or any ETH adjacent asset is a bad thing, but I think Bitcoin is very clear about what it is. So it's kind of semantically pure, and that's led to like a better story and kind of better adoption. And I think if you get yield attached to that, like, people are going to be really happy. But again, I think the demand is going to be insatiable. In terms of how this long-term plays out, I think, there's a ton of path dependency here in terms of the sales and the BD process, the vendor lock-in process, who works with who is always like kind of an open question. And that kind of determines how it ends up. I do think there's a chance that the LSTs on Bitcoin are less kind of power law curved, because I think you're going to have different services that each LRT or LST, whatever you want to call it, are tied to. And people will be comfortable with one set of risks and not another. And maybe they'll be comfortable with both and kind of bundle them together. But I don't think you'll get like a whole package, thing for a consensus staple on top, like you do with Lido, where Lido is like, we run the entire Ethereum client for you. You're not running the entire Bitcoin client. It's proof of work. So anything that's added is kind of your own unique risk that you have to be comfortable with. And it's going to have its own kind of simple kind of minimal smart contract risks attached to it. And I think that leads to like a bunch of LSTs kind of winning, not necessarily, one LST kind of dominating.
Okay. So I think what I took away from that is like, this ultimately still goes back to, I think, of someone like Alan Farrington, where it's like, where does the yield come from? It's like, we know that everybody wants yield, especially on Bitcoin, where the TVL is so massive, the opportunities are so little. And I think that's why, protocols like Babylon have seen such tremendous success. But maybe what you're implying here is that there could be some sort of yield. I think Babylon has a credible model where, they could do the time stamping of the proof of stake chains, and those would pay for security. But that there's seemingly, we'll see as this plays out, there's seemingly way more demand for yield than there appears to be yield to go around. So we'll kind of see, is that, will that change? Will people be wanting to pay for Bitcoin security and be able to, and these yields can earn more revenue, or will these things kind of balance out? But I think you're implying that it's still a little bit of an open question of like, just how much yield can we actually generate? Or is this going to be, ephemeral tokens that we're kind of subsidizing the yield with? So in this kind of future world, do you see ways that there could actually be credible and sustainable ways to earn yield? And what are they? I mean, I know that maybe I'm going here towards something like eigenlayer. Like, is eigenlayer going to run into the same problems where it's just kind of like restake your staked ETH, earn more yield on it, but we haven't really figured out where the yield's coming from yet? Like, what's the deal with that?
I think, you know, staking products tend towards verticalization. I think just we're used to, crypto MakerDAO is, 2019 and in 5 years, 6 years, we've had like an insane amount of growth and people are kind of used to that. But I think staking stuff and yield stuff tends to verticalize. So I think you just chase up, if you launch the LST eventually that's bundled with some sort of L2, and you're basically just internalizing the execution costs, the MEV, execution fees, priority fees, whatever you want to call it, from your own platform into your own LST and kind of creating this virtuous cycle. And it looks like a bank, right? Like the smart contract risk is different, but the bank has different services for its clients, but its ultimate goal is the clients keep the money on the platform. And, for any sort of like LST vault, it's going to eventually want its own L2. It's going to want to chase those fees. You could have, a nice relationship in terms of not having your competitors be your complements and your complements be your competitors. So maybe if you're like the winning LST, you want to provide everything to the L2s, because if you start to verticalize on your own, then the L2 will stop working with you and will work with the other LST. So I think that's, potentially reasonable. But I think how fast these things get built out, Base also being CBE, also having the distribution of Coinbase, like there's clearly a power to kind of this distribution that can come in. There's kind of clearly this power that if you have the ultra dominant LST, it's kind of easier to choose where that derivative, where that staking token kind of gets pointed, where the bespoke integrations are, right? So I think there's a bunch of ways it'll play out potentially. I do think it'll verticalize again, which would be like my hot take. I'm sorry, I think you had one more follow-up question there.
Well, I'm just trying to understand, like where do we think the yield will come from long term if these LSTs are actually sustainable? Are there shared security services that are credible enough to generate yield?
I think, the fees base is moving, right? They could point it to CBE and they could make CBE the gas token. And that would be a really simple model to incentivize even more usage of Base and even more usage of CBE. I think you could see something similar happen in Bitcoin. The amount of yield you could get from running the L2 tends on kind of the distribution and the apps you have on there. So it's kind of anyone's guess how much yield that actually is. I think in dollar terms, it could be immense, millions of dollars, hundreds of millions of dollars long term. I think in, basis points of the network or like where the yield's at now for staked ETH, it won't be 4%. It'll be like 0.1. But in the real world, in 10 basis points, 25 basis points. That's what the Fed cuts at, right? Because you have a currency that's huge, and that's where Bitcoin's headed, right? It's going to be huge. So 10, 25 basis points, one percentage point in yield is huge. That can kind of serve as the baseline, when you price in the risks of having the LST, the smart contracting risk for the lending rate, because you can kind of plug that into a lending protocol and you're like, okay, 1% is your opportunity cost or 1% is what you're making on top of this lending. But then I think, it looks like and this is, I'll be out over my skis on this a little bit, David, but it kind of looks like, the 1800s where you have gold lending. And in those models, especially in the ancient East, debt looks closer to equity, right? Like if you lend someone money, you're kind of an equity holder in the sense that you kind of own the success or not. If the business doesn't work, you're not going to get your money back. The person's going to be bankrupt. And that's why lending was smaller. That's why lending was between families. I think we're used to like this huge centralized lending entity because the government has kind of propped it up. And I think the lending on Bitcoin long-term will kind of be downstream of the staking yield that'll kind of come from the execution fees. But ultimately, it'll kind of have its own rate, right? And its rate will be, more like private loans, which tend to be, if you had private student loans versus if you got them from the government, they were substantially more expensive. And I think that's kind of where we're headed. Is that a bad thing? No, I think it's just, sound money has a high cost, I guess.
Yeah. Okay. So I think maybe some of those points I'll agree with, and you can see what I think. Like, I'm not sure that we'll see a ton of lending of Bitcoin long term, especially if it's denominated in BTC, the asset, because just rationally, like if I borrow Bitcoin and I'm willing to pay some sort of interest rate or some sort of yield for that, and then 2 years go by and the price doubles, like not only am I paying back the interest, but I have to pay back this like Bitcoin that's worth twice as much. So I don't know if I agree with that. I do think that there is some market for people to borrow Bitcoin, but it's denominated still in US dollars. So I could borrow, one Bitcoin at $100,000 today. And a year from now, even if Bitcoin price doubles, maybe I'm only paying $105,000 back with the interest rate. It's not denominated in Bitcoin. I think there could be a market for that. Like with these perpetuals exchanges, like people need to provide short exposure. So that makes sense. I think the more credible way that we can ultimately drive like yield in ways to earn on your Bitcoin is kind of what you alluded to, is ultimately we just need to drive usage. Like if, people are using some sort of service for payments or DA or sequencing or something, like they're willing to pay for these services that Bitcoin can secure. Bitcoin can secure certain infrastructure, which allows that usage to happen. And that's how you can earn it. But I'm not sure that we can like engineer in just yield and like, code up something and be like, this is just going to like earn yield. At the end of the day, it's like you have to build services that people want.
Yeah.
People, because they want those, are going to pay for them. And that is the ultimate source of yields. TLDR, it's just a distribution problem.
I agree. I think the counter is just like, if Base took all the revenue from their sequencer and was like, this is going to CBETH, right? And now CBETH makes all this L2 side chain.
Totally.
And this is like the scary thing. The hope is you have a broad enough set of L2s that the LST needs to work with all of them and can't just like pick a winner and kind of determine the winner.
Yeah. Dude, Base is scary. I mean, like I admire them, but they're doing something amazing. I did an interview with like Victor Bunin, who works at Base. He him and his wife are also investors in Alpen. And I kind of asked, I was like, dude, like, how does anyone beat Base? And he kind of like fumbled over his words. He's like, well, it's a big market. I'm like, oh shit, we're all screwed.
The question is, when are we getting the actual good Binance L2? That's the real Base killer.
Oh, you think Binance is, you think CZ's plotting something?
I have no idea. I'm just hypothesizing.
Interesting. Well, okay, so we're kind of coming up here. Maybe we can cover one or two more topics depending on what you want to do. I'll give it up to you. Like I had on my list here, like hot takes on Bitcoin culture. If you want to talk about maybe pros and cons of Bitcoin culture and where it's at, that could be a can of worms. Or maybe things that are on the forefront of crypto. I don't know, maybe Intense or something that you want to talk about and like how that could potentially come to Bitcoin. Either of those topics you want to take a stab at?
Have you asked other guests this, or have they picked one or the other?
Well, Bitcoin culture has been talked about ad nauseum. Like if you want to give kind of like what you guys are seeing on the investment side of like where some of these innovations are going, that could be interesting.
I think I won't speak to Bitcoin culture, maybe because I think there's probably people better suited who've been around longer. I think I'm kind of in the intersection, working with a lot of Ethereum people, working with some Solana people, and kind of being a Bitcoiner. I think a lot of people are fading, what's going to happen once you have expressivity on Bitcoin. I think a lot of people are kind of underestimating, not only like the average layman's ability to kind of understand Bitcoin and relate to it, and kind of, inflation last year was a huge topic, right? And I think, across the United States, people were frustrated with it. So Bitcoin saying, we have no inflation, like that's a pretty clear value add. And then once you add the expressivity, once you start to go towards, I'd be able to kind of like run this or verify this, this side chain, this credible side chain on my phone, which is, I think, where the future's going. I think people are kind of underestimating that. I think they're underestimating kind of what it'll do to all L1s and in the space generally. And then I think it's kind of, do we have like the right infrastructure around Bitcoin, the network, to kind of last any of these centralizing vectors and kind of, can it keep its credibility? Can it keep its 21 million promise? Can the sacraments be kept intact as, we kind of get global adoption of the religion? But no, I think my hot take right now is I think there's an insane amount of good people and smart people in Bitcoin who a lot of people in other circles are kind of underestimating because they're used to, Bitcoiners kind of being like religious or not open-minded and kind of being lightning cultists. And the reality is like you have some really smart people who can come in and learn stuff from ETH really fast and apply it to Bitcoin. And the second we get, something live that has some expressivity, I think it's kind of a new era. And I think you have to think about it as an investor differently. And, everyone's an investor in the sense everyone has money, everyone has time, and they have to kind of choose how to spend it. And I think, that's the lightning in a bottle moment we've all kind of been waiting for Bitcoin.
Totally agree. I think people are definitely sleeping on it. I think they're slowly starting to wake up on it as like more announcements start happening from like very credible people. And eventually they're going to kind of look around and be like, holy shit, like we just built this amazing modular ecosystem. Like, did we just do this for Bitcoin? And I mean, that's going to be pretty dope.
Yeah, that is dope.
Okay, I think that was probably a good one to end on. Any other kind of things that you want to mention or riff on, or should we close here?
No, I think that was awesome. Thanks for having me on. I really enjoyed it, David.
100%. Thanks, brother. We'll talk soon.
Peace.